If you've been in the stock market for more than a hot minute, you've probably heard some know-it-all jackwagon tell you to never try to catch a falling knife because you'll only end up cutting yourself. Well, I'm here to tell you they're wrong. Wrong, wrong, wrong. Okay, maybe they're not entirely wrong. A falling knife is a stock that's selling off super fast. Like, faster than Cathie Wood can light millions of dollars of other people's money on fire fast. Not trying to buy a stock as it's crashing makes sense intuitively, right? Since there's no consistently effective way to tell where a stock is going to bottom, if you try to buy on its way down thinking it can't possibly go lower, you might go all in too soon and end up with a huge loss. This is why many traders and investors choose to wait until a stock stops crashing before opening a position. Chickens. The problem with waiting is that a falling knife can turn into a whipsaw in an instant. A whipsaw happens when a stock's price suddenly reverses the sell-off and bounces. Sometimes this bounce can be so big that the stock returns to a higher price point than where the sell-off even started. If you wait, you miss a buying opportunity. If you don't wait, you get burned like a drunk redneck trying to juggle fire torches. Me, I love catching falling knives. I can't help myself. I've been doing it for 25 years, and my returns consistently beat the S&P 500 year after year. When a stock I own or want to own is dropping like a rock, it's on sale and I want to buy the living poop snot out of it. Yes, poop snot. Deal with it. The key is knowing which falling knives I can catch and which ones will cut all of my flippin' fingers off. So how do I decide which falling knife I can catch? First, I start by picking the stock of a quality company. Picking a quality company is like picking a quality candy. Chocolates, gummies, these are quality candies. But candy corn? I mean, what the actual is candy corn? It's not corn, it's barely candy. It's basically deformed mutant sugar that will rot your teeth out of your head. Who eats this? Friends, don't let friends eat candy corn. If you give me candy corn, I will so I'm not even joking. Candy corn is the devil. The devil, I say. Wait, where was I? Right, picking a quality company. When I say a quality company, I mean a company that is the best in its sector, often referred to as best of breed. No, not AMC, Bed Bath & Beyond, or GameStop, you nutjob. Get out of here with that flaming dumpster fire garbage. Quality companies are ones where I understand the product or service they offer, and I believe they'll be successful for the long term. This doesn't mean I can only pick older companies that have been around for years. I pick brand new companies too, but they need to bring something unique to the party. These new companies can't just be another Cathie Wood stinker claiming that innovation is the key to growth, but only turn out to be selling petrified eagle poop shaped like car batteries. And long term doesn't mean tomorrow, next week, next month, or even next year. Long term means decades, kids. When I buy a stock, I'm planning to hold it at least 5 years, and most of the time 20 to 30 years or longer. There are different kinds of sell-offs, and not all of them provide a good buying opportunity. Kind of like asking someone out. Sitting on a bench at sunset and asking for someone's phone number? That's the right time. Asking someone out on a date after you've hit them with your car? That's the wrong time. For me, the best kind of sell-offs are market-wide sell-offs. Market-wide or systemic sell-offs are awesome because every stock is selling off. Typically, a catalyst on the macroeconomic scale is causing investors and traders to sell. It's not stock or sector specific. When everything's on sale, I can buy up whatever I want because every stock's getting hit by the same negative event. Conversely, if only my stock is selling off, I need to make sure that my investing thesis is intact and that the company isn't imploding before I even consider buying more. If my stock is actually broken, I might have to close the position, not add to it. Want an example? Okay, let's take a look at Roblox, the game development platform that preys on naive small children. I mean, Roblox lets kids develop and play video games in a safe online environment. I think Roblox will succeed as a company over the long term. So after I gave the stock some time to establish price action after its IPO, I started buying Roblox in 2021 here, and here, and here. When the market-wide sell-off started in 2022, I bought Roblox here, here, and here, and here, here, and here, and here, 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 and here. By using this technique, instead of having a cost basis of $77 per share where I made my first buy, my cost basis ended up being $46.10 a share, a reduction of more than 40% from where I initially opened the position. After Roblox bounced, it ended up going above my new cost basis, and this is where I started taking profits. As you can see, this is hardly catching a falling knife. This is building a profitable investment over time by buying in stages. Obviously, when I do catch a falling knife, I don't blow my wad fraud and buy my entire position all at once. It's the opposite. I expect that the stock will sell off much lower than where I initially start buying. In fact, even at the bottom of Roblox's epic 2022 sell-off, I still only had about half of the total allocation in the stock that I wanted, because I always plan for the possibility of lower lows. You must never, ever trust a bottom. The only time stocks stop going down is when they hit zero. A lot of new investors find a new company and they think, if I don't go all in all at once, then I'll miss out on the opportunity. I must put in enough money to make it worth it. Wrong. If a stock goes higher after your first buy, that's a high quality problem. And we never worry about high quality problems. It's the low quality problem that will make you go bankrupt. I plan my entire investment in a stock before I make a single buy. First, I decide how much of my portfolio I want to dedicate to the stock, and I'm prepared to lose all the money I invest in the company entirely. That's right, I'm always prepared to lose all of the money I plan to invest in any company. To be a successful long-term investor, I must think about the risk I'm taking, not the potential reward. Sure, it's fun to imagine all the hot girls I'll pick up when my investment pays off. I mean, all of the sports cars I'll buy when I'm rich. To plan my investment, I look at the stock on a chart to figure out where I want to make my first buy, and it's at a price lower than wherever it is right now. I always wait for a pullback. In other words, you buy on red days and you sell on green days. For that first buy, I start out with a very small quantity of the entire amount I've allocated. Even if you don't have a lot of money to invest, thanks to commission-free trading and fractional share buying, anyone can buy in stages and start with small amounts. Next, I look back in the past and I find all of the levels where the stock might fall to, and I plan buying targets and quantities for each of those levels. Then I plug all of my limit orders into my broker and I wait for the market-wide sell-off. And I wait. And I wait some more. If you're new to investing, you will soon discover that most of the time the best course of action is to do nothing at all. In other words, don't just stand there, do nothing. If the stock never sells off, I either adjust my buying plan or I move on to a different stock altogether. What happens when catching a falling knife doesn't work? You'll notice that I intentionally said when and not if, because if you use this technique, it is a matter of when. There are going to be points where it happens. What happens if a stock goes to zero? It happens. In fact, if an investor ever tells you that they haven't had a losing position, that's just because they haven't been investing that long. It's true. Everyone gets a stinker once in a while. Everyone. The way I protect against stinkers, Coinbase, is by managing the risk I'm taking. Speaking of Coinbase, let's take a quick look at this piece of trailer trash. Coinbase finished out 2022 down 85.98%. And even with this absolute dumpster fire, my portfolio still outperformed the S&P 500 on the year. How did I protect myself? I opened my position at $412.47 on April 14th of 2021, the day of its IPO, and I bought all the way down. However, my current position in Coin is only 0.5% of my entire portfolio. That's barely a rounding error. Coin could go to zero tomorrow and have less effect on my bottom line than a mediocre day in the market. And yes, if Coinbase keeps selling off, I will keep adding to it, but I'm using tiny amounts. At this point, Coin is a lottery ticket more than it's an investment, and that's fine. I'm protecting myself by controlling my risk. I never put myself in a position where a single investment will take out my portfolio. Risk management is the only way for investors, and traders for that matter, to protect against the worst case scenario. Losing your entire portfolio. If I pick quality companies, wait for the right time, and plan my entire investment in advance, I can catch falling knives everywhere without worrying about having one hurt me. Well, at least not that much. If you want to follow along with the moves in any of my portfolios, you can do so absolutely for free at getirk.com. Please hit like and subscribe, and I'll see you in the next video.